Welcome to the deep dive on Consolidated Water Company Ltd., or CWCO. We are cutting through the noise of their Q3 2025 earnings call.
Right. And this is a fascinating one.
It really is. I mean, this company isn't just selling water anymore. They're selling engineering solutions. And the market clearly loved what it heard. The stock just soared to a new 52-week high.
And that's our mission for this deep dive, to unpack the surprising financials and maybe more importantly, the strategy that's driving them.
Yeah.
Because what we saw in Q3, it was not the report of a typical sleepy Caribbean utility. Not at all.
No, this is validation.
Exactly. CWCO is actively executing this transition into a high-growth, diversified water solutions platform. And, well, this quarter provided the concrete financial proof that the architecture they built is finally delivering.
Okay, so let's start with those headline numbers because they seem to catch the street completely off guard.
They really did.
We're used to seeing utilities hit their targets, right on the nose. But this was a major beat on both the top and the bottom line. So what was the absolute punchline for earnings per share this quarter?
Well, the earnings surprise was substantial. Deleted GAAP EPS from continuing operations hit 34 cents.
34 cents.
Yeah.
And to give some context, the general expectation from analysts, the street consensus, was where?
It was much lower, closer to 24 cents. So we are looking at a powerful material surprise of approximately 42% on the earnings side.
42%. That is a massive margin of operational outperformance, especially for a mature infrastructure company. It signals a fundamental shift.
It really does. It's a shift in their profit generation capability.
So how did revenue look? Did it follow that same trend?
It absolutely did. Total revenue landed at $35.1 million, which easily surpassed the consensus estimate of around $32.9 million.
Okay, so a solid beat there too.
A solid beat, and that represents a 5.2% growth year over year. But here is the critical data point for you.
Okay.
It's not just that revenue increased, it's that this growth was significantly more profitable. Gross profit dollars expanded, and the gross margin itself, it expanded by about 200 basis points, rising from 35% to roughly 37%.
That margin expansion is the key, isn't it?
It's everything.
And suggest this wasn't just, selling a higher volume of water. It was a higher concentration of higher value engineering and manufacturing work.
Precisely. And when management talks about the importance of diversification, they are banking on that margin lift. They stress that the 4-segment model, that's retail, bulk, services, and manufacturing, is the foundational strategy to deliver these long-term superior returns.
So if we analyze the segments, we can see exactly how that profit mix is changing.
Yes, let's do that.
All right, let's start with the base. The historical core of the business has always been the retail segment, the regulated utility operation down in Grand Cayman.
Right, that's the stable cash flow base, the anchor. And retail revenue grew by a modest 2.4%.
Okay, so steady. What drove that?
It was driven by a solid 6% increase in water volume sold in Grand Cayman. That reflects the strong local economy and, frankly, some drier weather, which just forced higher consumption.
So consistent, predictable, but not the growth engine.
Not the growth engine, no.
Now, the bulk segment, which sells water wholesale, showed a really curious dynamic. Revenue declined, but profitability improved. That seems counterintuitive on the surface.
It does, and this is where we need to dive into the accounting mechanics a little bit.
Okay.
Revenue for the bulk segment modestly declined by 4.3%. Now, the reason for that top-line drop was primarily lower energy-related pass-through charges, mainly in the Bahamas.
All right, let's unpack that concept of pass-through charges for a minute, because it is a vital distinction.
It is. So think of it like this. When they sell water to a government entity in the Bahamas, they charge the price of the water plus the cost of the energy, like diesel or natural gas needed to produce it.
So that energy cost is just passed through.
It's just passed through to the customer. So when global energy prices drop, the revenue number for the bulk segment drops, even if the company is selling the exact same volume of water.
Ah, I see.
And crucially, management stated that while the revenue declined, the profitability within the bulk segment actually improved.
Oh.
Due to superior operational efficiencies, they are managing their inputs better even when the energy cost component of the selling price dips.
That's a fascinating insight. It proves the core operational health is strong, even if macro energy prices are sort of obscuring the revenue line.
Exactly.
So now, where did the high-octane growth really surge? Because it looks like it was in the services segment.
That is the story of the quarter, no question.
Yeah.
The services segment revenue jumped a massive 12.7% year over year.
Wow. And what fueled that?
It was heavily fueled by construction revenue, which exploded 50% higher compared to the prior year. This signals they're converting those large project wins into recognized income.
Right. And they're not just relying on lumpy construction projects.
No, and that's the other piece. They continue to see reliable, steady gains from the recurring operation and maintenance, the O&M contracts, which balances everything out.
And rounding out the segments, the manufacturing business, it saw a strong revenue increase of 7%. And this is where we see that true technical differentiation. What was driving that for them?
Well, the manufacturing segment is all about high-value, specialized work. The revenue growth came from higher production throughput, certainly, but also from the production of specialized higher-margin products.
What kind of products?
They are building components for extremely demanding customers, like nuclear power facilities and complex municipal water customers.
And they cited their NQA1 certifications for this work. For the listener who isn't familiar with that, why is NQA1 certification so important, and why does it drive higher margins?
NQA1 is essentially the quality assurance standard mandated by the U.S. Nuclear Regulatory Commission. It is an incredibly rigorous standard for designing, constructing, and operating nuclear facilities.
So having that certification is a huge barrier to entry.
A massive one. It allows CWCO to bid on and produce mission-critical components for that sector. This isn't commodity manufacturing. This is precision engineering for environments where failure is simply not an option. And that high barrier allows them to command significant margin accretion.
Making this segment disproportionately important to the overall profitability story.
Absolutely.
This segment breakdown really shows us that the company's architecture is working. You've got the retail and bulk segments providing the stability, while services and manufacturing provide the margin and the gross momentum.
That's the model.
So now let's pivot to the future pipeline, which is arguably why the stock ran so hard. Management spent a lot of time detailing the status of the massive U.S. expansion, specifically that Hawaii desalination project.
Yes, that Hawaii project. The 1.7 million gallons per day seawater desalination plant for the Honolulu Board of Water Supply. It remains the single largest anchor for their growth in 2026 and 2027.
And the technical progress.
It's flawless. Management confirmed the design is 100% complete.
But there remains a crucial administrative bottleneck before they can fully break ground and start recognizing that substantial revenue. What is that key gating item?
It's not an engineering issue, it's a regulatory one. The critical linchpin permit remaining is the archaeological permit from the state government division.
An archaeological permit.
Yes. Hawaii has extremely stringent requirements regarding historical and cultural artifacts, and securing this specific permit is the final regulatory hurdle.
So once that's secured,
Once that permit is in hand, construction is expected to begin early next year, marking the start of the material revenue inflection for the next 2 fiscal years.
and speaking of U.S. expansion, Hawaii's the anchor, but they also just quietly secured beachheads in 2 other crucial U.S. markets that establish a crucial revenue stream for 2026. What did they win?
They secured approximately $15.6 million in new design-build contracts expected to convert into revenue next year. This includes a $3.9 million drinking water plant expansion in Lockwood, Colorado.
And that's significant because
It's incredibly significant because it marks the Colorado subsidiary, REC's, first ever design-build contract win. It's a foundational step that builds crucial momentum in a brand new market for them.
And the second win, that one was in California, and it highlights their focus on water reuse, which aligns perfectly with that long-term secular trend toward conservation in the drought-stricken West.
Precisely. The other contract is an $11.7 million deal for a wastewater recycling plant in the San Francisco Bay Area. They're building this for a golf club, and the goal is to convert treated wastewater for irrigation.
And what's the impact of that?
This initiative alone is expected to save 36 to 38 million gallons of precious potable drinking water annually. It just showcases their ability to execute these high-value, sustainable solutions in water-stressed regions.
So beyond these specific wins, management also signaled a massive market opportunity down in Florida, which is being driven by population growth and a shifting regulatory landscape.
They did, and they're preparing for it. The new 17,500 square foot Florida manufacturing facility expansion is complete.
Which means what for them operationally?
It means higher throughput, the ability to handle bigger custom units, and simultaneous management of multiple projects. It dramatically improves their workflow and scalability.
And the underlying driver for Florida is demographic.
It's all demographic.
Right.
Rapid population growth is pressuring existing water resources. And that pressure is forcing utilities to look deeper for supply, which changes the required technology.
Right. So regulatory changes are now requiring utilities to tap into deeper, more saline aquifers water that isn't fresh enough for standard treatment.
That's the key. This necessitates the company's advanced expertise in highly specific treatment systems like nanofiltration and low-pressure reverse osmosis, or RO. Standard filtration just won't cut it.
And their location in Fort Pierce positions them perfectly for that.
Perfectly. They can capitalize on this municipal bidding surge, turning a regulatory problem into a business opportunity.
And out in the Southwest, where perpetual drought is creating permanent demand, their Arizona subsidiary, PERC, is generating opportunities through advisory work.
That's right. They are seeing an uptick in requests for what are called custom design reports, or CDRs, from developers.
So a CDR is like a feasibility study.
Think of it as a comprehensive feasibility study and engineering blueprint for a specific water solution a developer needs. By investing time now to produce these CDRs, and they cited their prior successful Liberty Utilities project as proof, they are essentially planting well-watered seeds,
Positioning them to convert those leads into lucrative, large-scale design-build contracts down the road.
Exactly. It's a low-cost, high-leverage marketing tactic that pays off in future revenue.
So if we synthesize all these operational wins, the margin expansion, the segment growth, the project pipeline, what does this mean for you, the investor, looking at the structural context of the business?
It means they have immense optionality, and that's largely thanks to the strength of their balance sheet.
Which is formidable.
Formidable is the right word. The company holds an outstanding $123.6 million in cash and cash equivalents.
$123 million in cash, and the debt.
With virtually no long-term debt, we're talking about a negligible $30,000, they are effectively net cash and debt-free. That level of financial strength is truly unique in this sector.
A company holding that much cash with zero debt is playing a different game than its highly leveraged peers.
A totally different game. And they also made a significant move to clean up a long-standing balance sheet risk during the quarter, which further reinforces that fortress status.
Who was that?
Well, the CW Bahamas subsidiary had a large delinquent receivable balance with the government's Water and Sewage Corporation. During Q3, they collected approximately $12.5 million of that money.
So they got paid.
They got paid. This significantly reduced that outstanding balance to $16.8 million, materially lowering the overall credit risk profile of the entire company. It was a de-risking event that kind of flew under the radar.
Okay, so if we zoom out and connect this performance to the bigger picture, how is CWCO performing relative to the general utility sector?
They are materially outperforming. I mean, it's not even close. The one-year return for CWCO is approximately plus 27%.
Plus 27, and the sector.
Now, consider the context. The overall U.S. water utility sector, traditionally a safe haven, low-growth area, is actually down about 6% over the same period. And they are also beating the broader U.S. market, which is up about 13%. So the market is clearly rewarding their pivot away from purely regulated utility returns toward high-growth, project-based engineering services.
And as they prepare for this massive ramp-up in U.S. project work, especially Hawaii, the company also quietly shored up its leadership team and governance structure.
Yes, and this is a crucial forward-looking step. The appointment of 3 new independent directors in October wasn't just, administrative window dressing.
Right. It reinforces the board's capacity to oversee this expanding global project strategy.
It does. These new directors bring expertise specifically in public utility management, large-scale infrastructure execution, and international finance. That caliber of oversight is essential as they transition from managing smaller Caribbean systems to anchoring $204 million U.S. infrastructure giants like Kalaeloa in Hawaii.
So the forward outlook, while it lacks formal numeric guidance, is clearly focused on that revenue inflection point.
The focus is squarely on 2026 and 2027. That timeline is dictated by the construction ramp in Hawaii and the revenue recognition from the newly awarded $15.6 million in U.S. contracts.
Right. Colorado and California.
Exactly. We should expect near-term construction revenue to be somewhat lumpy, but the stability from the O&M contracts and that high-margin manufacturing business are expected to provide a steady underpinning until Hawaii really kicks into high gear.
And now it's time for This is Not Financial Advice.
Oh.
A crucial reminder. This segment is for intellectual entertainment only. No investment decision should be made based on this analysis. We are simply exploring the logical, though aggressive, implications of the source material.
The standard disclosure applies. Please, never trade on speculation.
So the setup here is laser-focused. The stock has already run hard on the growth narrative, and the current valuation, trading around 30 times forward earnings, already embeds much of the Hawaii project upside.
Right. A lot of the good news is priced in.
However, we identified that single, non-administrative permit that acts as the key constraint, the archaeological permit for the Kalaloa diesel plant. The entire 2026-2027 revenue story hinges on this one document.
It is the ultimate binary trigger. The market knows it's coming. It just doesn't know when.
So here is the outrageous but plausible trade idea. We are targeting an aggressive short-term structure that capitalizes purely on the speed and volatility of a definitive news release.
Okay, I'm listening.
The idea is to buy short-dated, out-of-the-money call options expiring early next quarter, say Q1 2026. We are wagering specifically on the press release announcing the finalization of that archaeological permit and the official notice to proceed for construction.
So why the use of short-dated out-of-the-money calls? That's betting on a huge spike in a short window of time.
Exactly. This specific permit is the final regulatory bottleneck before that massive $204 million project moves into the full revenue recognition phase. A short-dated option purchase is a bet on timing and volatility, not just value.
So if the news drops before expiration...
If it drops, it would trigger immediate institutional buying focused purely on the sudden certainty of that 2026-2027 revenue ramp. This could easily spike the stock much higher than the Q3 earnings results did, pushing past that recent 52-week high of $38 and change very, very quickly.
So it's a pure catalyst-driven speculation that leverages a known regulatory choke point.
Exactly. A truly focused swing trade based entirely on the progression of a state permit. High risk, but clear rationale.
I'll say.
So, to recap, the core takeaway is that CWCO's newly diversified four-segment model is yielding both higher margins and providing significant project visibility in the high-growth U.S. markets.
Right. And the immediate focus now shifts to flawless execution on that $15.6 million in new U.S. design-build wins and, critically, securing that final Hawaii permit before the end of the year or very early next year.
And this leads us to the final provocative thought for you, the listener.
Management is sitting on over $120 million in cash and virtually no debt while materially outperforming its peers. They are not merely saving that money, they are building a war chest.
So the question is,
how long will it be before the company decides to deploy a substantial portion of that cash balance into a major tuck-in acquisition in the U.S. design-build market? An acquisition that could instantly transform the scale of their project pipeline and their geographical footprint overnight. That is something for you to mull over.
That potential M&A event could be the next major chapter in this growth story. Thank you for joining us for this deep dive into Consolidated Water Company.
We look forward to having you back for the next conversation.